In this video, traders, we're going to look at a swing trading strategy to use on a 4-hour chart. Stay tuned. Hey traders and investors, a very warm welcome to you. Okay, so a swing trading strategy that we can use on a 4-hour chart. We need to use Bollinger Bands set on a 20 period and 2 standard deviations. Bollinger Bands are a moving average, a 20 period moving average, and a 2 standard deviation band around it. Talk about more of that in a second. That's the trigger for the trade. But it's a 4-hour chart, and we can use this on the major FX pairs. We can probably use it as well on the indices, but it's a good one for the major FX pairs. Let's explain the rules. Let's see what's going on. Okay, so we have our chart here. We have our price kind of chugging. Well, we have a moving average that kind of does this, right? And we have Bollinger Bands that kind of squeeze tighter, they expand, they squeeze tighter, they expand. If you've seen Bollinger Bands, you're going to know how they work because they're based on a standard deviation rather than the Keltner channel. They move, expand, and contract. So the idea of a Bollinger Band, just get my purple pen, the idea of a Bollinger Band is that as price touches the upper Bollinger, that generally would put the brakes on the move. If it touches the lower Bollinger, it put the brakes on the move to the downside. It doesn't always work like that. Very often price will hug the upper Bollinger as it rips and rips and rips and rips and gets a lot of momentum, and vice versa. So you've got to be careful how you use it. As with any indicator, guys, you've got to be very cautious. But this is a different way of looking at price and trading. And you know what? I'm going to pick out my purple pen. That will do me nicely. Okay, so we have price coming along and it goes, it touches, and it trades above the upper Bollinger Band, okay? That's the key. Now, once we have that, that's the first part of the filter. So number one, price is above the upper Bollinger Band, right? It's got to go above it. Touch it close enough, whatever, close enough. Now, this is the trigger for the entry. On a 4-hour chart, don't forget, so each of these is 4 hours. Now we have a big move that comes down and closes below the middle of the Bollinger Band. Now, that doesn't have to be the next candle. You don't want it kind of, I would say, let's go 3 candles. You want it on the same day, really. So you could have maybe 1 or 2 that go lower. Then you have a big one. The important thing is, this second candle, I'm going to put red here. This red candle has to be a decent size. It has to be a bigger size than all the others. It has to go below, so less than the moving average, which is the middle of the Bollinger Band, less than here, and has to close in the lower third. Okay, so if we had our candlestick here, right, there's our, as we know, if this is a red candlestick, we've got solid red, that's our open, that's our close, that's okay, that's our lower third, because that's our high, that's our low. What we don't want is this kind of thing, right? We don't want that. Yeah, we don't want to see that it's closed anywhere higher. So we need to see basically all the things that would filter out decent bearish sentiment, decent supply coming into this. The important thing about this, the reason this works and the reason this is a good strategy is that bulls have kind of driven this thing up, right? They've pushed it up, driven up nicely to highs. It's shown strength because it's touched that upper bolly, which is the 2 standard deviations, which you've got set on your chart. And now, all of a sudden, something's come out that's caused it to just change sentiment. So it's a quick change in sentiment, which is always a good thing to grab hold of as a trader. Now, like I say, you may get 3 or 4 or 2 or 3 days of backing off that top bolly, but it's, as long as it's within a reasonable time period, that then comes down through that middle, closes at the low. What's the trade? The trade is you're selling short at the low, at the close of that candle. So you have to wait for the close. You want to see where it is. Now, do you want to jump the gun a little bit? I don't mind. Some people are like, oh, never jump the gun on stuff. Listen, if it's down heavily on the day and you've got 30 minutes left and it's on the lows, and the chances of it rallying back a third are low, then make a little bit of a judgment call on it. Take a little bit now, take a little bit of the close, play around with it. I'm not one that says you've got to stick exactly to stuff when it's likely to do it anyway and it's fitting the criteria. But the real, actual rules are you wait for the close. So if you want to wait for the close, wait for the close. Set an alarm for 5 minutes before the close and hit it. The close of the 4-hour bar, by the way. So number 4, our stop then goes above this bar here. Now, for some, that might be a bit high, and I get it. So if you can find an area intraday where there's a little bit of resistance to work off, then fine, do that. I think as long as you find a good place where you think the sentiment's shifted back again, that's good for me. But, you know, you can work on a kind of format of doing that. Stop above the high. Okay, and then your target, which is the tricky one, is you want to see this kind of come down, do some stuff down here, and when it comes back under, this is a bad example on this chart because you're not going to make much profit in here, but generally speaking, this is going to be much lower because this move is going to bring the moving average down, it's going to bring the Bollinger Band down. But you want to exit as it comes back up under that middle. Now, why are you waiting so long, I hear you say? So that doesn't make any sense. The reason you do that is because if this is a significant change in sentiment and you've pushed up to highs, you've now come back to lows, this thing could go down and down and down and down and sit in that lower band range for a long, long time, hugging that lower Bollinger. What you don't really want to do is come out just when it tags that lower body, because it might do it quite quickly. And this might be low anyway, and the Bollinger Bands won't have had time to expand yet. So you're kind of not giving yourself much juice in the trade, and the risk reward ratio is not that high. So if you wait for that mean to follow the price down, you could be on the end of a really nice reversal, and then you're just waiting for it to pop back up and cross over that midpoint. But it keeps you in the trade if it's a brutal, so you got, you know, multiple 4-hour candles going down, driving down. You might get a little bit of a pullback, but that probably won't go back to the 20 period just yet. It'll roll over, and then when it's finally exhausted itself, it will come back under that midpoint and you can come out of the trade. So like I say, guys, 4-hour chart, major FX pairs this is good for. Not too bad for the indices as well, but major FX pairs. And you're setting Bollinger Bands, you're on a 20 period moving average, or 20 setting on your Bollinger Band, which is a moving average, and a 2 period standard deviation. Taking it short when it comes after it's touched the high bolly through the midpoint, covering it as it comes back up through the middle after, hopefully giving you a little bit of juice. If you know you have your stop there, I would suggest tightening up a little bit as it starts to go your way. Bring it down, tighten up. If you're right, the momentum's going to drive this thing. You don't want it coming back on you, but that's not a bad point to initially frame your risk and then ratchet it down as price starts going in your favor. All right, guys, swing trading strategy to use on a 4-hour chart. See you next one. Take care. Bye-bye.